So HP just dropped its Q3 earnings, and on the surface, things look pretty good. We're talking about their fifth straight quarter of revenue growth, all thanks to that big AI PC wave. But the stock pretty much went nowhere. So what's going on here? In today's Talk Tickers Explainer, we're going to dig into the numbers and figure it out.
And this is really the heart of the puzzle, right? You get a solid beat on revenue, but the stock actually dips a bit after the announcement. That kind of disconnect is a huge signal. It tells you Wall Street is looking right past the shiny headline numbers and focusing on something else. Let's see what they're seeing.
Okay, let's start with the top line. Revenue came in $13.93 billion. That's a pretty solid beat, about $110 million over what analysts were expecting. And like I said, that's 5 quarters of growth in a row, a streak that's almost entirely being driven by their PC business. Remember that part, because it's really important.
Now, moving down to the bottom line, earnings per share landed at 75 cents. No drama here. It was exactly what everyone was expecting. It's fine, but fine doesn't exactly get Wall Street buzzing, No real surprise here to get investors excited.
But hold on, now this is a number that makes you sit up and take notice. $1.5 billion in free cash flow. This is the cash machine. This is what fuels everything from their dividends to their stock buybacks. For a lot of people, this strong cash generation is the #1 reason to even own HP stock.
All right, so if the headline numbers were generally solid, where's the problem? What's holding the stock back? Well, the answer is kind of hiding inside the company itself. You see, HP is really a tale of two very different businesses right now, and they are headed in opposite directions. And just look at this. It's kind of crazy how much this company has changed. The personal systems division, laptops and desktops, now makes up over 70% of the entire business. Remember when HP was basically the printer company? Well, that legacy print business is becoming a much, much smaller slice of the pie.
And here it is, folks. This is the whole story in one slide. The PC business, it's growing at a healthy 6% clip. But the print business is still shrinking, down another 4%. But here's the kicker. Look at those margins. Print is wildly profitable. So you have this situation where the low-margin part of the business is growing, while the high-margin cash cow is slowly fading. That puts a real squeeze on overall profits.
Now, let's switch gears to another big issue that was hanging over the stock: tariffs. If you remember last quarter, this was a huge concern, and it really hit the share price hard. Well, this time around, management came to the earnings call with a very clear plan of attack.
So what they didn't just sit around and wait. They rolled out this really smart 3-part strategy. First, they got super aggressive about moving manufacturing. In fact, the CEO said that pretty much all PCs headed for North America are now built outside of China. Wow. Then, they're finding ways to cut costs and tweak their pricing. All in all, this is a huge step in de-risking their entire operation.
And hey, don't just take my word for it. The CFO, Karen Park, came right out and said it on the call. They handled it. They mitigated the majority of those tariff costs this quarter. For investors, hearing that directly from the C-suite, that is a massive confidence booster. It shows the management team is on top of things.
So with that tariff risk now being managed pretty well, let's turn to the growth story. Because honestly, this is the most exciting part of HP's future. We're talking about the AI PC boom. And this isn't some far off in the future idea. It is happening right now. AI PCs already account for more than a quarter of their sales mix, which is a full quarter ahead of their own plan. They're seeing fantastic growth and, get this, they're able to charge 5 to 10% more for these machines. This isn't just hype, it's turning into real dollars.
And it looks like there's a long runway for growth here. You've got this AI adoption wave happening as we speak, but then comes the big one. Next year, on October 14th, 2025, Microsoft is ending support for Windows 10. That is a hard deadline that's going to force a huge number of businesses to upgrade. And after that, all eyes will be on an investor day in early 2026 to see what's next.
So, let's bring it all home. We've looked at the results, we've broken down the 2 segments, we've seen the growth story. Now it's time to put on our analyst hat, look at what management is guiding for, and deliver our final take on the stock. Looking ahead, what is management promising? Well, if you're looking for fireworks, you won't find them here, and that might actually be a good thing. The theme is steady as she goes. They're guiding for Q4 earnings that are right in line with expectations, and crucially, they're sticking to their full-year free cash flow target. The message is basically, we're executing and we expect our margins to hold up.
All right, here's the bottom line. For the next call, we are rating HPA market perform. The whole thesis is a classic tug of war. On one side, you have this fantastic AI PC growth engine that's really pulling the company forward. But on the other side, it's dragging this old, heavy anchor, the declining print business behind it. Until that growth engine can really overpower the drag from print, we think the stock is likely to just, well, perform with the market.
So that's our take. The big question going into next quarter is pretty simple. Can the AI PC acceleration finally start to outrun the decline in print? It's going to be fascinating to watch. Thanks for tuning in to Talk Tickers, and as always, this is not financial advice.